Hey everyone, welcome back to the channel. I am Jay Duffy, co-founder of Frame Wealth Partners. Today we are tackling a question I've been hearing a lot lately. Jay, are we in a market bubble? Well, with the markets hitting new highs and AI stocks leading the charge, it's quite frankly a fair concern. But before you start panic selling everything and hiding cash under your mattress, let's break this down. Oh, and when you get a second, don't forget to hit that like button, subscribe, or leave a comment. We're here to help. So, what is a bubble really? The word bubble gets thrown around all the time, but it's actually hard to define. Markets go through cycles. Sometimes it's excitement, sometimes fear. Yes, we've seen true bubbles before, the dot-com era in the late 90s, the housing boom in the mid-2000s, but many times investors worried about bubbles that never materialized. In fact, after 2008, many braced for the next bubble, only for that decade to become the longest bull market on record. Let's be honest, if predicting bubbles was simple, I'd already be retired, probably running a tiki bar on a beach instead of filming this for you. Valuations are high, but that's not the whole story. Right now, stocks look pricey by historical standards. Investors are paying a lot more for each dollar of company earnings compared to the long-term average. But here's the important part. Expensive doesn't automatically mean danger. High valuations often reflect optimism about the future, like strong business fundamentals or the potential of new technology. And markets can keep rising for years, even when they appear expensive. And this time around isn't the dot-com bubble all over again. Back then, many companies were barely making money, if at all. Today's leaders, especially in tech and artificial intelligence, are profitable, cash rich, and have proven business models. That doesn't guarantee smooth sailing, but it does mean the foundation is much sturdier than it was in the late 90s. So yes, prices are high, but it's not like we're buying Beanie Babies on eBay in 1999 and calling it an investment. Number 3, opportunities beyond the headlines. Yes, big AI names grab headlines, but not all parts of the market are expensive. Large cap growth stocks are pricey, sure, but small caps, value stocks, and sectors like financials and industrials, those offer more attractive valuations and still have solid earnings growth. Diversifying across different sectors and styles helps reduce concentration risk, so you're not putting all of your eggs in the AI basket. Think of it like, well, a balanced diet. Some steak, some veggies, maybe even dessert, but not just Red Bull and Skittles, if you know what I mean. Number 4, time is your greatest ally. Here's the most important point. Time in the market beats timing the market. Even those who invested at the worst possible moment, the 1929 peak before the Great Depression, eventually achieved positive returns by staying invested long-term. Market bubbles and crashes fade when you zoom out to decades of compounding. So unless your retirement plan is 3 weeks away and involves winning the Powerball, long-term discipline is still your best friend. So what's the bottom line? Yes, valuations are elevated. Yes, there will be pullbacks, but that doesn't mean a bubble is about to burst. Instead of obsessing over short-term headlines, focus on what you can control. Diversification, risk management, and aligning your portfolio with your financial plan. Here are some tips to consider. Number 1, remember, valuations don't predict short-term moves. Markets can stay expensive for years if fundamentals are strong. Number 2, diversify across sizes and sectors. Avoid concentration risk in one hot area like AI. Number 3, stay disciplined with time horizons. History shows patient investors are rewarded, even during bubbles. Number 4, use dollar cost averaging. Spreading out investments smooths volatility. Number 5, work with a qualified advisor to keep your portfolio aligned with your long-term goals, not short-term fear. So remember, at Frame Wealth Partners, we believe your financial plan, not market noise, should guide your decisions. If you're worried about today's valuations, let's talk, because your goals, not the headlines, are what we help you frame. Have a good one. Take care.